Areas of focus for market watchers include the impact of a slumping dollar and, of course, the substance behind all of this AI buzz. With us now is Jason Schenker, president at Prestige Economics. Jason, great to have you back. So we saw last week, for example, banks easily beating lowered expectations. I mean, the bar has been set so much lower now. How are we expecting the markets to react to this earnings season?
Well, Sherry, I think that there is still quite a bit of concern going into this earnings season because of the elevated interest rates, which are really pressuring companies with their capex and what they can do with investments. And there's also still a lot of pressure from high costs of labor and a tight job market that are pressuring profit margins from the OPEX side. So I think a lot of companies are really trying to navigate these two serious issues that both threaten the bottom line. And there's really a lot of uncertainty going into this earnings season, and we're likely to see the same in the next one as well.
You mentioned elevated rates, but there's a reason for that, right? Elevated inflation, which has also been eating into the profits and margins of these companies. So where do you expect the Fed to take us from here, given all of the conflicting eco data that we got last week?
Well, there's one big thing I want to point out about last week's headline CPI number, which was a really big drop off, really great thing to see. But a lot of that was a year-on-year base effect. And last year in 2022, April, May, and June, month-on-month numbers were really big. For example, last June, prices went up 1.2% month-on-month. This year, they went up 0.2. And so that means, because we didn't have nearly as big a rise as last year, that eroded a lot of the year-on-year effect. Moving forward through the balance of the year, if we have only modest inflation rates, say 1.5 to 2 0.15 to 0.2, so 1.5 tenths to 2 tenths each month, we could see this actually creep up on the headline inflation and be between 3 and 4% through the balance of the year. And that means we're not going to get down to that 2% target that the Fed's looking for probably until Q2 of next year. And for core CPI, that's really what's going to drive Fed decisions moving forward. We think it's possible we won't get back down to that 2% number until Q2 2025. But there's plenty of good stuff to see, like the drop in the goods PPI number year on year. That's down 4.4%. Last year was up 17.9%. So we are moving in the right direction, but it's going to still be a little bit longer. And that's why we could still very well see those 2 more Fed rate hikes before year end.
You know, that sort of time will tell thing also applies to the biggest driver of the rally so far this year, of course, the AI chip-related tech names. When it comes to the monetization and the value chain for AI, are there still opportunities that are less tapped, I guess, going forward?
I think the biggest potential value for AI is in worker productivity in various corporate roles. I talk to lots of groups about this topic, as I'm also the chairman of the Futurist Institute. And some of the biggest things that people spend a lot of time on in, say, HR, crafting job descriptions or writing LOPs, putting together project plans, writing memos, press releases, all those things. If you're able to do more of that, especially in a tight labor environment, that means you can actually do more with less, right? You're able to be more productive. That's something that could boost company productivity. I think that is, as we think about the overall economy, probably the biggest opportunity, because if we look at some of how we've seen hype locusts begin to price in the impact of AI on big tech, a lot of that might already be captured in there. And we may be missing the bigger story, which is the productivity lever across the economy.
Jason Schenker, we're out of time, but always a treat having you with us. Thank you so much. President of Prestige Economics. We have more to come on Daybreak Australia. This is Bloomberg.